Hey gang, this is Billy and Shaun. Peterson Wealth Services point of view. Here we are again. We've got our fancy headsets on. We've got all this good microphone, good audio equipment. So today we're going to talk about inflation. It's surprising. Inflation is still here with us. We got the report yesterday that came in higher than expected. So we're not out of the woods, guys, and we don't think we're out of the woods here for a while. So we thought we'd title this one Bidenomics and poor policy decisions. So I don't think many people would be surprised that we've been talking about this for a while, that most of these policies actually created the problem, and they're certainly not doing much to help it. The Inflation Reduction Act was definitely not an Inflation Reduction Act. Mostly that was just a can of pork and extra spending jammed into a bill that no one had time to read. And now we're dealing with further spending and more inflation. So we're not saying that disaster is looming, but we are saying that the Federal Reserve has a lot more work to do. So today we want to talk about just the severity of this inflationary period of time and what might come out the other side. Also, what got us here, hopefully what gets us out of it, and how to position portfolios and what to expect in the economy. So even along the lines of jobs and household security, things like that. So jumping right in, let's talk about what got us here. Shaun,
Please
you want to take that
it.
one? I mean, that's a can of worms, buddy.
I'm going to say the C word, okay? Not the one
Careful.
Maybe some of you are thinking, keep it clean here on this show, family show, but COVID. I mean, we flash back and we look at COVID. We were shut down. We printed a ton of money, made the Fed late to the party with raising rates and getting inflation under control. But when I look at like, well, why is inflation here? I point at that, and it's sad that we're still talking about it. But a lot of those decisions that, in our opinion, were poor decisions, now we're starting to see the consequence of those decisions. And one of those consequences is inflation. I mean, supply chain issue also with the shutdowns, and now we're starting to reap what we sow, if you will. And it's frustrating, and we're not trying to get political. This is just, in our opinion, this is facts. This is what happened. We overshot that with COVID. Everyone freaked out more than needed. Not to say that there wasn't, serious issues with the virus, and people did lose their lives. I'm not undermining that at all, but to lock everybody down and mandate that and mandate a mask and mandate vaccines, I'm rambling on, and I'm not meaning to, but it just, you can't do all that and expect not to have some consequences for it. And that's what we're seeing now. And it's not immediate, right? So when all those things happen, we're talking 3 years ago, it's like when you throw a rock into a smooth lake. The ripple doesn't hit the tide for a while. Well, the ripple's starting to hit the tide now, and now we're trying to figure out how to get out of this with monetary and fiscal policy that are going in opposite directions right now. So yeah, a little frustrating. I got to admit that, but it's where we are.
We've seen some of these consequences already. The conversation usually falls back to inflation and how long this is going to last. Policy is what it is. And most times politicians will do things to generate more attention and gather more votes. And so we know that most times these people who are running the country are doing things not necessarily for the benefit of the country itself, but to secure their reelection. Sure. So let's be honest with that. I always try to look at the other side of any argument. I don't care what we're talking about. I don't want to just listen to what seems good from somebody's mouth. I want to look at what is the benefit to a certain sector or a certain group of people who gains from this decision. And so most people in this country are not gaining, other than the elite and the very, very wealthy, from this inflationary environment. We're seeing a huge dichotomy. We're seeing the middle class get hit hard, and we're seeing the upper echelons of the wealth continue to gain in net worth and financial security. And that's just how this works. And that's printed money. That's money that we didn't have to reignite an economy that was artificially shut down. Okay. And you have the bottleneck with the supply chain, on and on and on and on. We're telling you things that most of you already know, but we're also telling you that inflation is not under control yet. And that's just a mark from going out there and trying to buy things in retail stores, going to a restaurant, trying to get a table, going and trying to buy a new truck. The money that's flowing in this economy is still extreme, on the extreme end. And that's because there's been money tossed into this system that wasn't there before. We printed it, and now it's making its way out there. The Federal Reserve is doing its best to try to extract it by telling people it's going to cost you more money. The banks are going to charge you more to borrow. It hasn't slowed people down enough yet. So we think the Fed's got more work to do. Inflation is still an issue, and it's starting to come down, but it's not even close to being where it needs to be.
Billy, jumping on your point there with inflation and how it's affecting, lower class, upper class. I think the median income in the United States is right around $70,000. So making $70,000, even making $100,000, it's not going very far anymore. So that's where you're seeing this divide. People that are making way over that, they're going, okay, I haven't been on a trip for a while, or I haven't done this. They're spending a lot of money. But other people might be watching this going, hell, I'm living paycheck to paycheck, and I was making good money at some point, but now you're making that same amount of money and your cost of goods are through the roof. So these are the people that are hurting, and it's frustrating because those are the backbone of our economy, right? The middle class,
consumers,
the consumer, and that's what scares us a little bit, gives us some pause. And we're going to talk a little bit about recessions coming up here, but I think that is something that we really need to be aware of, is this kind of divide we're seeing right now, and who gets it in the shorts on this is the lower and the middle class.
Yeah,
Frustrating.
they are definitely in the targets right now for if we do have a recession, slow down, and businesses start to cut some jobs, which we anticipate this coming. That's something that always happens when you see a Fed trying to lower the growth rate of an economy, which is essentially their job, is to bring inflation back down to 2%. With that, consequences are job losses. We're going to see it. We're still spending money. So you have the Biden administration on one hand spending as much money as they can. We're throwing money around like it's water or growing on trees. Yet the Federal Reserve is doing just the opposite, trying to extract it, trying to bring the spending down. And it's two different forces at work, and it's going to be very, very tough if we're at odds like that. So jumping over to some of the things that we think are hitting home for you all and how this impacts everybody else is, will a recession ensue? And if so, how big of a recession, how deep of a decline does that mean for the economy? And in turn, how does that affect your portfolios out there? So we're going to show you some things about how we're positioning portfolios for an upcoming potential recession. I think as if we were to put odds on it, we're suggesting maybe a 50% likelihood of a recession, not saying it's going to be deep or severe. Many economists that we follow believe that the Fed can engineer a soft landing and we won't see a recession at all. We're just going to see this kind of ebb and flow. Certain sectors of the economy will struggle a little bit, but overall, the economy continues on this trajectory of slower growth because they're going to navigate this softer landing, and it's not going to crash. It's not going to hit us hard.
Yeah, that's good. And I like to look at, let history be our guide. So I like to share this chart, and the two lines I'm focused on here. I'm focused on the gray line, and I'll go over that. And then I'm focused on these bar graphs right here. So gray line represents Fed funds rate. And we're going back to early 2000s here. And we can see we start with a hiking of rates, kind of leveling off. And then this gray bar represents a recession. So typically before a recession, you're seeing rate hikes occur. Same thing here through the mid 2000s. And then we hit a recession. And then we go to this zero interest rate environment for a very long time. Okay, we were spoiled with that. And then we start hiking rates. Things are kind of getting back to normal. And then boom, COVID hits. No one knew we had a recession. Hardly anyone knew because we were all just talking about COVID and shutdowns and, this and that. But we did go through a recession.
Yeah,
I want to say other things, Bill, but
I like when people say COVID hit me, but to be more accurate, and I've said this many times, it wasn't COVID that hit you. It was the government that hit you. It was the policies that hit you.
it really was. I mean, seriously, looking back at that. Anyways, I'm not going to beat a dead horse on that. So now we are hiking rates again, and look at the steepness of these rate hikes. This is what we're talking about, the fastest rate hikes in our history. So if history is our guide, it's looking like we'll probably see a recession because of these rate hikes. And that's what the Fed wants. I mean, it's kind of sad to say that. I'm not, saying hey, we want people to lose jobs, but it's just, we've got to slow the economy down, because what happens if we don't? If we don't, and inflation keeps going the way that it's trending now, we're talking like 1970s, 1980s type of environment where inflation is 20% and a house loan is 15%, car loan is 10%. I mean, that's wild, and we don't want to see that. And then you really have to rip the Band-Aid off. So
Right.
the Fed is kind of trying to engineer this soft landing, which is what we're thinking is going to happen, hoping for. Yeah, I mean, I don't want to try to predict the future, but with all the money that's been pumped in to the market, it's still there. It still has its effect. So even though the Fed is hiking rates the way that they are, I think the consumer is in a much better position than they were, say, in 08, 09, where they were highly leveraged, debt to the gills, and then you lose a job or something like that and you can't sustain. I think the consumer is stronger in that area now than they were in the past. So you don't see such a collapse of the market, if you will. And I think the other good news that we haven't talked about too much is, hey, the market struggled last year. Stock market, bond market struggled last year, and the reason, in our opinion, is that it's priced in what's to come. I think that markets are very forward looking. They're very liquid. They adjust to future events that they're predicting rather than looking backward. So, hey, you're seeing high inflation, you're seeing a war breakout, you're seeing kind of a slowdown of the economy. So, hey, the market priced in a recession. We think a lot of that is baked into the cake. Not to say we're completely out of the woods. We're definitely going to have, pauses in the market, but
recessions are normal.
Yeah,
and we have a number of them in history. So it's not like the recession is this doomsday scenario, but the media will try to paint it that way. So just remember, if we have some day in the future where some news broadcaster jumps on and says U.S. is in a recession, it doesn't mean all of a sudden the markets are going to plunge 20 or 30%. We talked about this before. The market's already anticipating all this stuff. It's not news to the market. That's already old story. The market's probably already recovering for the next cycle when that news becomes public knowledge. So what can warn us of a recession? Well, there's some things that are pretty obvious. Unemployment starts to rise. Consumer confidence starts to decline. Right now, average consumer confidence has been pretty positive. Housing starts to decline. The unemployment rate right now, we're running unemployment less than 4, but you start to see that go up to 5-ish. You're going to start seeing the signs of a recession. Inverted yield curve is the biggest one we watch here in the financial industry, and that's just a metric to watch the short-term rates versus the longer-term rates. And whenever you see a 2-year rate surpass the 10-year rate, that's counterintuitive, because you think, well, I have to lock my money up for 10 years and yet I get a less return than a 2-year bond. So it makes no sense. But the reason why that happens is investors are starting to anticipate that there's going to be a recession, and thus there's going to be lower rates in the future. So the people that jump onto some of these short-term investments thinking that they have just slayed the hog are going to find out that it's not such a good investment after all. if in fact the economy slows. So Shaun's going to put up a chart now talking about these short-term rates like money markets and CDs. Just to paint the picture a little bit, money markets are yielding 5.25 or 5.3 right now. And CDs are yielding, a 1-year CD is yielding 5.3 or even 5.4. So we hear this a lot. People are taking huge chunks of their total portfolio and wanting to move that into these short-term investments. And remember, it sounds fine, and it is fine for a short period of time, but then you have the reinvestment problem. When that comes due, the rate is drastically lower than what you locked, and it's going to come due obviously in 12 months. And money markets are changing every day. So there's no term on that. The safer, I say safer, the safer investment is one that stays up with inflation. But let's look at this and see how all these CDs do. Just as a general rule, if your fear is market volatility, and so you don't want to buy stocks, and so you think CDs are a great place to be, I want to give you maybe a different way to look at that. Go back to 2004, and we'll carry that out for 20 years. CDs, the nominal yield on the CD, so you go to the bank, what is the CD paying? Well, it's paying 2.5 or 1.4 or 0.77 or whatever that may be. And so some people look at this today and compare it to the last 10 years and think this is fantastic, jumping on a 5.3% CD. Now carry it over and see that we have to pay taxes on that income for sure. So knock that out by 24, 25%. Then the more important position is, most people don't even think about this, is inflation, the cost of living, the prices of goods and services. How fast is that growing? And did that even keep up with the return on your CD? So if you take out your taxes and inflation, you can see on the far right, that's your net. If you're looking at this video, you're seeing almost all of those in red. If you're not looking at it in a video, just listening to me talk, I can tell you right now, there's been only 2 years where you've had a positive real return on your CD investment. So we're telling people, be very, very careful about these short-term investments. If you're plugging long-term money in for a short-term investment, I think you've made a mistake. I like the idea for short-term needs for sure. If it's cash or an emergency fund or something that you've got just set up for a home you're going to buy next year or 2 years or a vehicle, great. Look, buy a CD, buy some money market funds. But beyond that, this isn't a retirement idea.
Yeah. Billy, we talked a lot in this video about, inflation, possible recession. I mean, if I'm listening to this, I'm thinking, okay, guys, what should I do? How should I prepare myself for a recession? Any tips you want to share with everybody?
Yeah, so there's some great advice that we would like to share within portfolios, also just with your short-term cash. So we've been talking about cash. If you don't have an emergency fund, get that set up. An emergency fund, to us, just means 6 to 9 months of living expenses set aside in something that's liquid and not moving around or not fluctuating in value. So we're not taking that and putting it into Bitcoin or Ethereum or whatever other cryptocurrency you might think. That's not a safe haven investment. Something that's going to hold its value. So whether that's cash or some short-term investment like that, that's what you need to do for sure. Have that set up, because if you see a recession ensue, there's going to be some job losses and you don't want to be left out there hanging. Minimize your debt, avoid all credit cards, don't have any high interest loans, and please don't strap yourself up to a whole bunch of additional debt that's cutting into your budget. So making it too tight to get by month to month, buying boats and trucks and cars and, that discretionary spending that we all talk about, think we need, but we really don't. That's where I'd minimize some of that, Shaun.
That's good. I'll add one more in there. I think with your cash, if we do see a recession and the market happens to react poorly to it, be ready. Be ready to take advantage of it. This could be a very good entry point into the stock market. People that are investing in their 401ks, don't stop. Some people will say, "Oh, I'm losing money, I'm going to stop that." Well, flip that around and say, "Hey, I'm actually able to buy more shares of these funds or these companies that you're taking a look at in your 401k plan. So be prepared that way. I think most wealth is made during recessions. When you think about that, people that take advantage of it and then you climb out of a recession. So I think in closing, just to summarize, our take is, look, inflation could be around for longer than what's being predicted out there. Recession on the horizon. We're thinking a mild recession. And then, as far as what we're doing in some of our stock models, we're considering maybe cutting back on some of these technology holdings that have run up so much, and maybe looking at some more of your consumer staples, your healthcare companies, maybe getting a little bit more defensive in our positioning. And when we say that, guys, we're not trying to scare anybody. We're just saying, hey, you need to be nimble. You need to make adjustments for what you think is going to come forward. So if you're a client of ours, we'll be making those adjustments. If you're not and you have questions about what we're going to do, give us a call. We're happy to discuss that with you.
Yeah, taking into consideration the tax impact, we're not just jumping in and out all
Sure.
the time. You know that we're watching how that affects everyone out there from a tax standpoint. But there are certain things in certain times. Again, this is just our view of the world. We're not right every time, but so that's why we never jump all in or all out. Yes,
I am
Shaun.
right. I am right every time.
Okay, well,
That's a
he's
joke.
making a bold
Put that
prediction.
in the disclosure. That is a joke.
We want to make sure that you guys understand that we are anticipating things or projecting things based on the news that we get. We take all angles, all views. One other point on news media: be very careful what you're listening to out there. There gets to be some awfully biased and awfully unreliable sources of information that covering everything, whether that's market just to create drama and fear. They love fear because it sells, and they love to side with their own narrative or their own agenda. So be very careful of who benefits from certain things that get spent. I don't care what it is, but when we're talking about in this country that everyone thinks they need to jump on a social bandwagon or some sort of a spending plan that we have to do it, you need to start thinking, why do we have to do it? Is there some benefit to us from this immediately? Is this a dire consequence or dire situation? And which entities benefit most from this conversation or from this level of additional spending that we're talking about? Mm-hmm. We don't have the money. We need to budget in this country very, very severely. We need a budget. And we have media that's extremely, I'd say, challenged, biased, if you will.
How polite of you.
Yeah, very, very nice of me. I'm trying to be nice and walk that line. But we have some politicians. Just to wrap this up, there are politicians that are providing a lot of false information out there, guys. And I think most of you will agree with that. But we're not the corrupt shareholders in this that they make you out to be. We invest in companies that for a benefit for our shareholders and for our clients. And we want to make sure that you understand the difference between investing for profit and gouging consumers, which is what many of them will have you believe, that all these CEOs out there are just setting prices and they're the ones that are setting this and making this inflation problem that we have. Whereas in fact, markets set prices. It's not one company that gets to set a price for a product or a service. You know, the consumers get to walk. They get to choose where they're going to spend their money. Somebody's too high in their price, they're going to go out of business. And that's how this whole thing works. So be careful what you're listening to, what you're believing. We're trying to give you that, peel back the onion a little bit, tell you what we're seeing and why, how long this might last. Hopefully not very long.
You're telling me it's not the capitalist fat pigs on Wall Street CEOs sitting somewhere? You mean
I mean, there's probably some fat pigs in there. I don't. Well, sure. I'm not trying to defend all of them, but I don't think we need a blanket statement that says everybody that's a capitalist is a jerk and a creep and taking advantage.
Well, AOC thinks that, but you're right. I mean, these companies are raising their prices not because they're trying to gouge. It's because all their input costs are up. Okay, their labor costs are up. Their widget, if you're simple, their widget costs are up to build it all. So it's not that. And I think that's a good point that you laid out there, Billy, for sure.
Yeah, it all comes through the supply chain. We'll get this ship back righted, and like we said, we navigate these markets as they come to us. We're not looking in the political landscape just to stir the pot. We're trying to look at it from what it brings us and what opportunities it creates, also what potential difficulties it might create. We're not on here telling everybody that we're doom and gloom and getting out. We're not doing that. We think there might be some pockets of opportunity.
Three things I'm going to say, and we'll wrap it up. Stay calm, keep your long-term perspective, okay? Maintain a balanced and diversified portfolio, okay? If you get nervous, you speak with your financial professional, okay?
Yep. Don't go
Pretty
out on
easy.
a whim. My last one is don't go out on a limb with a bunch of extra spending that you don't really need to do right now. All right. Tighten up just a little bit and watch your spending habits.
Perfect.
Thanks for joining us, folks. Hope that wasn't too overwhelming for you. But if you ever want us to get further into the details on politics, we're happy to. Now, if you'd like to debate us and talk about some of these things, hey, call us as well. We love you all, and we're here to help.
Thanks all.
Thanks for tuning in. Take care.